Everybody's out here turning their spare bedroom into a 5-star resort. But what happens when the resort starts running you? Short-term rentals exploded into the mainstream around 2015. And suddenly, every podcast guest was a 20-something with 3 Airbnbs and a poolside photo preaching passive income like it was a religion. Then the algorithm changed, the regulations hit, and the occupancy rates dropped. And a lot of those evangelists got very quiet very fast. We went from quit your job in 90 days headlines to I sold all my STRs and went back to long-term leases confession videos. And that whiplash tells you everything about where we actually are right now. Here's the thing nobody puts in the thumbnail. Short-term rentals are not passive income. They are a hospitality business wearing a real estate costume. You are essentially running a hotel, except you're also the front desk, the housekeeper, the maintenance crew, and the guest relations manager, all for the price of one mortgage. The burnout isn't a character flaw. It's a structural inevitability if you scale the wrong way. Think of it like building a skyscraper on a foundation designed for a beach house. It works until it catastrophically doesn't. Back in 2021, hosts were averaging over 90% occupancy in top markets. And AirDNA was reporting average daily rates spiking 40 to 60% above historical norms. Everyone saw dollar signs, and almost nobody asked the follow-up question: what does this actually cost me in time, energy, and sanity at scale? Now, markets like Nashville, Scottsdale, and Smoky Mountain are seeing saturation levels that would have been unthinkable 3 years ago, and the hosts who scaled recklessly are quietly offloading properties. The ones still standing and thriving share one quiet, boring superpower: systems before scale. Here's the historical pattern that keeps repeating itself across every asset class. The early adopters win, the FOMO crowd overpays, and the survivors are the ones who treated it like a business from day one. We saw the same arc in the early days of house flipping, in the condo conversion boom of 2005, and now we're watching the third act play out in short-term rentals. The misconception that kills most operators is thinking that adding more doors automatically adds more profit. But without infrastructure, each new door just adds more chaos. 1 property is a side hustle. 5 properties without a system is a full-time job that you hate. The operators who scale without burning out are running playbooks that look almost boring from the outside. Virtual assistants handling guest messaging, professional co-hosts or property managers eating 15 to 25% of revenue in exchange for your sanity, and dynamic pricing tools like Price Labs or Wheelhouse, making rate decisions so you don't have to. The math only works at scale when your time cost approaches 0 per unit, because your time is the only truly finite resource in this equation. Practically speaking, your first move before adding any new property should be to document every single repeatable process in your current one, because you cannot delegate chaos, you can only delegate clarity. The operators who burned out didn't lose because short-term rentals are bad. They lost because they tried to hold everything in their heads instead of building the machine that runs without them. Position size matters enormously here too, because going all in on 5 STRs in one market is a regulatory risk, a seasonality risk, and a platform risk, all stacked on top of each other. The disciplined operators diversify across markets, mix in some midterm rentals as a buffer, and never let any single platform or policy change be able to sink the whole portfolio. There's something almost philosophical about the way this business forces you to confront your own relationship with control, because scaling means releasing it. And most people who are drawn to entrepreneurship are, ironically, control freaks. The exit from burnout isn't fewer doors. It's better architecture around the doors you already have. And here's the quiet irony at the center of all of this. The people making the most money in short-term rentals right now are often the ones you've never heard of, because they're too busy running their systems to be on a podcast telling you how they did it. The noise is always loudest at the beginning and the end of a cycle. The signal lives somewhere in the boring, disciplined middle. Whether the short-term rental market corrects further or finds a new equilibrium, the operators who survive will be the ones who built for resilience instead of growth at all costs. And that's a lesson that applies to every corner of real estate, every cycle, every time. You don't have to predict the market perfectly if your systems, your team, and your position sizing are built to absorb the surprises. If you want to figure out where short-term rentals fit in your specific investing strategy, or if real estate investing, contracting work, or finding the right lender is where you want to start, check out our links in the description below and let's build something that actually works for your life.